In this week's video, we'll ask the question, how vulnerable is the stock market as we once again approach new highs? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. These are the weekly charts of the S&P 500 that we cover regularly in these videos. This is what the chart looked like during a risk-off period in 2008. This is what risk-on looks like in 2009. Risk-on, or a full-bore bullish look, is price above both moving averages, blue above red, and the slopes of both moving averages are up. You can see, despite the 9-point decline this week in the S&P 500, we're still maintaining a full-bore bullish look. This looks a lot more like this than it does this week period in 2008. We also held above this line here. What once was resistance may now act as support. We're using the same concepts here, moving averages on weekly charts. The blue moving average in all of these examples is always the fastest moving average. There are 13 moving averages on this 2015 chart here. 38 bad things can happen. How do we get 38? There are 13 moving averages. The slopes of all 13 can roll over. Notice the slopes are down here. Price can also drop below all 13. 13 and 13 is 26. And then we can get 12 bearish moving average crossovers as blue starts to drop. In the present day, out of the 38 bad things that can happen, observable things, we can see the changes. Out of the 38, how many have happened as of the close on Friday, May 1st? The answer is 0. If you're a client, you can see why when we did chess move A, we need to redeploy that capital last week, 2 weeks ago, into chess move B. Why? The market's profile is still bullish. This is a daily chart of the S&P 500 as of 1:18 p.m. on Friday, May 1st. You can make an argument here, a legitimate argument, that this is a failed breakout on the daily chart. However, as we pointed out on Twitter earlier this week, since the October low, the S&P 500 has made 5 new significant higher highs. And you can make an argument that we had a failed breakout each time. Broke to a new high, eventually went down. Made a new high here, it failed. Made a new high here, we reversed. So this really isn't that much different than this period here, here, or here. And the most important thing is that bullish conviction relative to bearish conviction has been strong enough to push us to new highs on 5 occasions. The amount or number of significant new lows that we've had over the same period is 0. The moral of the story is we're still in an uptrend. We're making a series of higher highs and a series of higher lows. Are the failed breakouts concerning and relevant? Yes, they are concerning and relevant. However, we've been doing that and the market continues to go up. Until we make a significant lower low, the game plan is to try to stay with our long positions as we did in the last 5 trading sessions. We'll go into next week with a flexible and open mind. And if we get into this area here, the rules will probably call for some defensive action. That did not happen this week. We need to see it. It could happen next week. We'll just have to see. The market was friendly to the bulls on Friday with the big rally. From a failed breakout perspective, The broader NYSE composite, which is actually more important than the S&P 500. Why? It contains thousands of stocks and gives us a much wider and broader look at the economy. It was able to rally back above every single one of these areas of previous resistance. The daily chart closed above all of these dotted lines. All things being equal, the longer we stay above these dotted lines, the better. Could we see a failed breakout? Yes, we could. If we move into this area here, our concerns would increase. And if we move into this area here, they would increase even further. The market model uses numerous moving averages, numerous moving average pairs, and numerous charts and risk-on, risk-off ratios. Why? None of them are perfect. Many of them can add value. These are weekly moving averages, different weekly moving averages. This is one set tracked by the market model. This is what fear looks like. October of 2007. Here, bearish moving average crossover. Blue goes below all of them, and the slopes of all of them are down. These are the exact same moving averages on the exact same time frame, weekly, as of the close on Friday, May 1st. Could this chart morph into something like this beginning next week? Absolutely, positively, yes. We don't anticipate that. We need to see it, and if we do, we're happy to take defensive action. Now we're going to take a step back and look at the weight of the evidence. What is the big picture telling us right now? This is consumer staples relative to the S&P 500 in a risk-off period in 2008. This is a full-bore bullish look in favor of defensive consumer staples. This is what the same chart looked like in a risk-on period when the stock market bottomed in the spring here of 2009. Does the present day chart, the exact same chart on the same time frame with the same moving averages today, look more like this period here or this period here? It looks more like a risk-on and favorable period for stocks. This is a full-bore bullish look in favor of fear, the VIX relative to the S&P 500. This is a full-bore bearish look in favor of stocks. This is what risk-on looks like. The present day still looks more like risk-on than risk-off. Same exact concepts. Full-bore bullish look for bonds here in 2008. This is what fear looks like. The aggregate demand for bonds is greater than the aggregate demand for stocks here. This is fear. This is what confidence looks like. The stock market bottoms. I'd rather own stocks relative to bonds. This is risk on. This is the present day. This looks a lot more like this than it does this. When fear picks up, typically foreign markets lag the S&P 500 as they did here in 2008. When confidence begins to pick up, often foreign markets start to lead rather than lag. This is typically what a bullish look looks like. The present day looks more like this period here than this period here. Same concepts, we'll shift gears a little bit. What happens if Europe is what derails the markets in 2015? If you've been in the markets for some time, you remember Europe was a problem in 2011. EFA, Europe and Asia, a laggard in 2011. When the stock market bottomed and became more confident, EFA was a leader. This typically is what confidence looks like globally. This looks a lot like the present day as of Friday, May 1st. 2011, when concerns about Greece were stealing the headlines, Spain, EWP, was clearly a laggard. Here in 2009, Spain, EWP, a confident look, was a leader. The present day is trying to morph from a bearish and concerned look in 2015 here to a more constructive and bullish look. This is a full-bore bullish look in favor of EWP and looks a lot more like this period here when risk on was in favor. If we're concerned about Greece or Europe derailing the bull market, everything that we just said about Spain applies to the present day chart, a full-bore bullish look for Italy, EWI, relative to the S&P 500. Chris, what about the currency wars? We're printing money all over the place. It's only a matter of time before a currency collapses. This is what fear looks like in 2008. Gold, a clear leader relative to the S&P 500. This is what confidence looks like. Stocks start to lead relative to gold. You can see the present day has a full-bore bearish look against gold relative to the S&P 500. This is a zoom in here. This 2015 looks a lot more like a constructive and bullish period for stocks in 2009 than it does this period here when risk on was on the back burner and risk off was ruling the day. In 2008, during the financial crisis, probabilities favored being short technology over being long the S&P 500. When the market became more constructive here in March of 2009, the S&P 500 bottoms right here. You can see the ratio flipped over. It's observable, and now this is in favor of SPY. The present day, as of 2:17 p.m. on Friday, May 1st, looks a lot more like this constructive period for equities in 2009 than this unfavorable period for equities in 2008. Maximum fear is typically a deflationary event. So even if the stock market peaks as a result of a spike in interest rates, eventually bonds typically would get a bid. Intermediate credit here starts to lead in 2008. Here, when the stock market bottoms in 2009, credit starts to lag the stock market. This is a bullish look for equities, and this looks similar to the present day on Friday, May 1st. Everything that we just said about intermediate credit applies to CSJ relative to SPY. The present day here looks a lot more like this constructive period for stocks in 2009. Why do we keep showing the same concepts over and over? Because it speaks to the weight of the evidence. The more charts that we have that are pointing in the same direction, the more confident we can be about our current positions. Corporate bonds, the demand for them spiked relative to stocks when fear spikes in 2008. Here, when the stock market starts to bottom, we get the bearish moving average crossover in favor of stocks relative to bonds, and we shift from a full-bore bullish look to a full-bore bearish look in favor of stocks relative to corporate bonds. The present day has a full-bore bearish look favoring the stock market over corporate bonds, broke one trend line, two trend lines, and tried to make a new low on the ratio. This is what it looked like as of 2:14 on Friday, May 1st. To summarize, our approach is a lot like weather forecasting. We take knowns, just as a meteorologist does, and we make short-term probabilistic forecasts. When the knowns change, the charts change. These are observable changes that we can see that start to take place in October of 2007 as the stock market peaks. Here's one right here. The blue moving average makes a lower high. Our slopes start to roll over, and we get a very, very bearish warning that's observable before the calendar even flips over to the financial crisis marked 2008. Could this chart, or any of the charts that we've shown, morph into a bearish look? They could, and that may start next week. We don't anticipate that. We want to see it. If we see it, we'll take the necessary defensive action. For now, the charts and the probabilities are telling us to have an equity-heavy portfolio. We will do that as long as the charts, facts, and observable evidence allow. We'll head into next week with a flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.